Okay, thank you. Before we go into some more deep down questions, I would just like to, with the help of Paul and Mike, reflect of the companies we've seen here presented, the 25 cleantech companies. And I don't want you to make an evaluation, just from a European point of view, Paul, how do you view the novelty and the quality of these companies?
Well, I believe that the 25 companies which has made a short presentation this morning, that is more a very good reflection of our deal flow we get in as fund. You see all kind of companies. You see companies which are still looking for defining the proof of concept, but you also see companies which already are in the market, commercially spoken. You also see companies which are still in the process of moving from lab to pilot, from demonstration, and so on and so on. So I think from that point of view, a lot of sectors were also represented. What I was missing a little bit is what I think is a big wave which is coming to us is everything which is in the field of electrical cars and mobility and clean transport, and also smart grid. But in general, I think what we have seen today is also what we currently see in our deal flow at Capricorn.
Mm-hmm. And Mike, how would you say that these relate to what you typically would meet in the US?
Sure. You know, my involvement with the Cleantech Open has allowed me to see about 200 similar companies over the last 4 years. These companies are very similar to early stage cleantech companies in the US. When I look at companies entering the CTO, very similar. I think part of it though is when you look at these companies like a snapshot of a car, is the car going 10 kilometers an hour, 100 kilometers an hour? Is it stopped at a light? You can't tell. These companies change so quickly. 18 months down the road, there's probably going to be a few winners out of that 25. Which two? I mean, that's the trick, right? If someone knew that, they'd be, you know, working with you probably. So.
Mm-hmm. Okay, well, we'll go into some different subjects of the developing of a company, and one of the areas that often is discussed when raising capital is the percentage or the valuation or the ownership. And if I address you, Anders, it's rather a rule than an exception that things may go wrong, projects are delayed, money is running out. How would you view that the entrepreneur who is actually making progress in his project, although not as fast as anticipated, should still maintain a fair share of what he's about to create?
I think that the general attitude is, of course, you have to analyze the situation first to see what are the cause of the events. If it's sometimes it actually is mismanagement, then or the founder didn't deliver what, or the entrepreneurship team didn't deliver what they actually kind of promised, then it's more difficult to be generous. But if it's, as most cases, I think everybody comes across, very seldom the actual plan is followed completely as planned. And then the circumstances normally will tell what has happened. But most of the time you're anxious to make sure that the entrepreneurship team is motivated. So you don't want to dilute, so you take out the motivating factors. And then you have to look at various mechanisms, and there is a lot of different mechanisms you can use to maintain ownership shares that makes it interesting for entrepreneurs to continue, even although the owners also must have increased their share, as there is quite a big increase in capital, as an example, or the risk has increased, or whatever the situation is. But in general terms, make sure that the management team is motivated. I think that would be the bottom line of it.
As long as possible. Right.
Yes.
Eric, from the entrepreneur's point of view, when you start up the company, the only currency you have is your 100% as a group or alone, depending on how you started it. And somewhere you have to start trading this currency towards capital to enable faster growth in your company. And in your case, as you have raised money, when and how did you see that now it's time to really boost the growth, and even though it will cost us the percentages or the holding?
For us, it has been very important to keep control over the company.
Yes.
But of course, that doesn't mean that you need to have 100% of the company. So it has been very natural for us to take in money when we have, because we have usually used it as counter-finance to grants that we have received. And then you need a certain amount of money, and you just have to take them from some investors. And then, of course, it's always trying to understand how much money we will need in the next phase, and then calculate so that we still control the company, that we feel that would be the best for the company.
Yeah. Anders, you have something to add?
Yeah. What not very often happens, if you have a consortium, a syndicate to finance a company that is delayed, needs much more money, there may be one syndication partner said, if enough is enough, and they want to not invest anything more. What do you then do? If the rest of the investors say we will continue, you want to penalize the investor that doesn't continue with you. So then what you can do is, of course, you make a washout. You reduce the valuation very much, and then you give shares back to the management team in order to make sure they still own it.
Still on board, yeah.
You want to get rid of the guys that don't want to play the game.
Mm-hmm. Sure.
This is a kind of tactics within the community that all of these guys know of.
Yeah. Well, smaller companies, and Mike, with your experience of really early stages, do not necessarily make a major round. They do smaller rounds and lots of rounds, and they get family, friends, and fools on board, which will sort of result in a situation with a lot of small owners. And how often do you find that, and how do you view a company that may have 30, 50, 70 owners, although a minority situation?
Frankly, it could be very messy for a new investor coming into that situation. I've seen it, a company with 30, 40 investors, mishmash of share prices that were paid, and very unrealistic expectations, and it sometimes can make it very difficult to get a professional investor into the company. I usually coach entrepreneurs, if you're going to go with angels, try to find angels that understand your business, understand the market, they know what they're getting themselves into, and hopefully will help make the company more successful with their expertise as well as their money. Personally, when I was running a company, instead of doing angel money, I just went for a VC round. The idea being, if you can raise it, well, you may give up, usually around a third of the company. It could be fast, where, you find a good VC, you raise a round, the money's in the bank. You don't have to raise money for hopefully the next year plus. A lot of times with angel funding, you raise a little money, buys 3 months. A little more money, buys another 3 months.
Yeah.
You're constantly fundraising and just chews up a lot of time.
Yes, which really brings me to the next question that, for instance, Lassie, it's often so that you have to spend so much management time in raising money because you are making so many rounds. And we see it from Sting point of view. We have to train our entrepreneurs to become good investor presenters rather than businessmen. And as soon as you have secured one sack of money, you have to almost immediately go out to find the next, which is very unproductive in terms of developing your company. So how is your position to that, and would there be a way to secure all the capital required ahead of time and then sort of milestone your way forward?
I think it's very true that once you complete one round, especially in a capital-intensive business, you immediately start looking for the next round.
Yeah.
And it consumes a lot of energy. It confuses the management to a degree. It's oftentimes also exaggerated, that it's not so bad if you have the people who do that, and your technology director doesn't need to be too involved in that. But also reflecting to some of the things that were said before, I would say that my hunch, and this is not scientific, is that those companies that raise more capital at the expense of dilution, in my view, end up being more successful than those that try to protect their percentages for a longer time. And this is, in my view, because like somebody said here, there's so many good companies and technology changes. So the time to market is really, really essential in many businesses. If you wait too long, chances are that something more clever will pop up, and you want to get your product out there.